This week we're going to talk about short-term investments and receivables. We'll cover short-term investments along with receivables to emphasize their relative liquidity. Short-term investments are the next most liquid current assets after cash. So the first thing we're going to do is to learn how to account for short-term investments. Short-term investments are also called marketable securities. These are investments in marketable securities easily converted to cash that a company plans to hold for 1 year or less. They allow the company to invest cash for a short period of time and earn a return until the cash is needed. Short-term investments are the next most liquid asset after cash, which is why we report short-term investments in marketable securities immediately after cash and before receivables on the balance sheet. So obviously this makes them a current asset. Short-term investments in marketable securities fall into one of three categories: trading, available for sale, and held to maturity. The investor expects to sell a trading security within a very short time, a few months at most. Therefore, all trading securities are included in current assets. The other two categories of securities can either be current or non-current, depending on how long management intends to hold them. However, available for sale and held to maturity securities are usually classified as non-current unless they mature in the current period. The purpose of owning a trading security is to hold it for a short time and then sell it for more than it costs. Trading securities can be in the form of stock or debt securities of another company. Suppose a company purchases IBM stock intending to sell the stock within a few months. If the market value of the IBM stock increases, the company will have a gain. If IBM's stock price drops, the company will have a loss. Along the way, the company will receive dividends or may receive dividend revenue from IBM. If the company purchases a debt security such as a bond, it would receive interest revenue. The entry to record the purchase of a stock investment is shown first. The second entry is to record dividends received from the investment. And so we can see that if we're purchasing an investment, we're going to debit investment in ABC stock as an asset, and we're going to reduce the cash by crediting cash. If we receive dividends as a result of that investment, we're going to receive cash, so that would be a debit to cash and a credit to dividend revenue. Trading securities are reported on the balance sheet date at their current fair value, also called market value, because fair value is the amount the investor can receive by selling the securities. If the fair value at balance sheet date has increased from the original cost of the investment, the company reports an unrealized gain. It's unrealized because the company has not actually sold the investment. On the other hand, if the fair value has decreased from the original cost, an unrealized loss is reported. The entries to adjust trading securities to fair value are shown here. These entries are made at the end of the reporting period. If the fair value increases over the period, the investment account is increased and an unrealized gain is reported. If the market value decreases over the period, an unrealized loss is recorded and the investment account is decreased. On the balance sheet, short-term investments are current assets. They appear on the balance sheet immediately after cash because short-term investments are almost as liquid as cash. Report trading investments at their current fair value. On the income statement, investments in debt and equity securities earn interest revenue and dividend revenue. Investments also create gains and losses. For trading investment, these items are reported in the income statement as other revenues, gains, and losses, so that they don't get combined with sales or product revenue, which we compare from period to period to look for trends. So we report them separately so that they don't skew the results of other core operations. A realized gain or loss occurs only when the investor sells an investment. This type of gain or loss is different from unrealized gains and losses. The result may be a realized gain which is equals to the sale price is greater than the investment carrying amount, or a realized loss where the sale price is less than the investment carrying amount. Accountants rarely use the word realized in the account title. A gain or loss is understood to be a realized gain or loss arising from a sale transaction. Unrealized gains and losses are clearly labeled as unrealized. A company will report gain or loss on sale of investments among other items of the income statement. Now we want to talk about how we apply GAAP for proper revenue recognition. Revenue should be recognized when it is earned and not before. Revenue recognition is proper when the seller of goods and services has done everything required to earn the revenue by transferring the good or service to the customer, and when the customer has assumed ownership and control over goods or the service provider has substantially completed the service. In addition, the price of goods or services is fixed or determinable, and collection is reasonably assured. The amount of revenue to be recognized is the cash value of the goods or services transferred from the buyer to the seller. The amount of revenue to be recognized is the cash value of the goods or service transferred from the seller to the buyer. The timing and amount of revenue recognized is determined by the shipping terms and payment incentives offered by the buyer and the seller. The proper time to recognize sales revenue is when ownership of goods changes hands between the seller and the buyer. This point is determined by the shipping terms in the sales contract. When goods are shipped FOB or free on board shipping point, ownership changes hands and revenue is recognized at the point when the goods leave the seller's shipping dock. When goods are shipped free on board or FOB destination, ownership changes hands and revenue is recognized at the point of delivery to the customer. Sometimes businesses offer customers sales discounts for early payment in order to speed up cash flow. A typical sales discount incentive might be stated as 2/10N/30. This expression means that the seller is willing to discount the order by 2% if the buyer pays the invoice within 10 days. After that time, the seller withdraws the discount offer. Regardless, the buyer must pay within 30 days. Companies with plenty of cash often take care of early payment discount on their purchases, thus adding to their reported profits and cash flow. The entry to record collection of a sale after providing sales discount is shown on this slide. Retailers and consumers have a right to return unsatisfactory or damaged merchandise for a refund or exchange. This is called sales returns and allowances. Retailers keep track of sales returns over time and make sure they are not excessive. The entry to record a sales return is shown on this slide. Retailers, wholesalers, and manufacturers typically disclose sales revenues at the net amount, which means after sales discount and sales returns and allowances have been subtracted. Now we want to talk about how to account for and control accounts receivable, which we said also is a current asset. Receivables are the third most risky asset after cash and short-term investments. Receivables are monetary claims against others. Receivables are acquired mainly by selling goods and services and by lending money, which would make them notes receivable. A business's accounts receivable are the amounts collected from customers from the sale of goods and services on account. Accounts receivable, which are current assets, are sometimes called trade receivables or merely receivables. The accounts receivable account in the general ledger serves as a control account that summarizes the total amounts of receivables from all customers. Companies also keep a subsidiary record of accounts receivable with a separate account for each customer. These T accounts illustrate the control account, accounts receivable, in the general ledger, and the individual customer accounts in the subsidiary ledger. The subsidiary ledger provides the detail of the accounts receivable balance. And so from here we can see that we have a subsidiary ledger that shows customer A owes us $5,000, customer B owes us $1,000, and customer C owes us $3,000. The total of all of these customer balances are reflected in the general ledger under an accounts receivable control account that simply says all of our customers together owe us $9,000. And we would also see the same thing with respect to accounts payable. We would have an accounts payable general ledger account that is comprised of individual amounts we owe to vendors who have provided us with goods, and those individual amounts and vendors' names would be in an accounts payable subsidiary record. Notes receivable are more formal contracts than accounts receivable. For a note, the borrower signs a written promise to pay the lender a definite amount at a maturity date plus interest. This is why notes are also called promissory notes. The note may require the borrower to pledge security for the loan. This means that the borrower gives the lender permission to claim certain assets called collateral to the borrower if they fail to pay the amount due. Businesses that sell on credit receive most of their cash receipts from collection of accounts receivable. Internal control over collections on accounts is important. Chapter 4 discussed internal control procedures for cash receipts, but another element of internal control deserves emphasis here. That's the separation of cash handling and cash accounting duties. The employee who is responsible for the accounting of receivables should never handle cash collections. This means the bookkeeper should not make the bank deposits. If he or she had this cash handling duty, the bookkeeper could lap accounts receivable. Alternatively, he could steal an incoming customer check and write off the customer account as uncollectible. The customer doesn't complain because the bookkeeper wrote off the customer's account, and the company therefore stops pursuing the collection. The supervisor or other employee who is not responsible for record keeping could open incoming mail and make the daily bank deposit. The bookkeeper should not be allowed to handle cash. Only the remittance advices should be forwarded to the bookkeeper to credit customer accounts receivable. Removing cash handling from the bookkeeper and keeping the accounts away from the supervisor or other designated employee separates duties and strengthens internal control. Using a bank lockbox achieves the same separation of duties. Customers send their payments to the bank and directly to the bank, which records the cash as the cash goes into the bank account, and then the bank forwards the remittance advice to the bookkeeper who credits the customer account. By selling on credit, companies run the risk of not collecting some receivables. Unfortunately, some customers don't pay their debt. The prospect of failing to collect from a customer provides the biggest challenge in accounting for receivables. Here are the management and accounting issues a business faces when the company extends credit to customers. Next, we want to talk about evaluating collectability using the allowance for uncollectible accounts. A company gets an accounts receivable only when it sells its product or services on credit. Ideally, the company would collect cash for all of its receivables. However, companies rarely collect all of their accounts receivables, so companies must account for their uncollectible accounts. Selling on credit creates both a benefit and a cost. The benefit is that customers who cannot pay cash immediately can buy on credit, so sales and profits increase. The cost is that if the company cannot collect from some customers, we label these costs uncollectible account expense, doubtful account expense, or bad debt expense. Uncollectible account expense is an operating expense in the selling general administrative category along with salaries, depreciation, rent, and utilities. The best way to measure bad debt is by the allowance method. This method records collectible losses or collection losses based on estimates developed from the customer's collection experience. The company doesn't wait to see what customers will pay. Instead, it records the estimated amount as uncollectible account expense and also sets up allowance for uncollectible accounts. Other titles for this account are allowable for doubtful accounts or allowance for bad debt. This is a contra account to accounts receivable. The allowance shows the amount of the receivables the business expects not to collect. The allowance shows how much of the receivable has been suspensed. Accounts receivable are reported at net realizable value on the balance sheet. This is the balance of accounts receivable less the allowance for uncollectible accounts. This is the amount the company expects to collect from its customers. The allowance can be shown as a separate line item on the balance sheet as shown in the top figure, or it can be combined into one line item shown on the net on the balance sheet. The best way to estimate uncollectibles uses the company's history of collections from customers. There are two basic ways to estimate uncollectibles: percentage of sales method or aging of accounts receivable method. The percentage of sales method takes an income statement approach. The aging method is a balance sheet approach. The percentage of sales method computes uncollectible account expense as a percent of revenues. So that's why it's related to the income statement. This method takes an income statement approach because it focuses on the amount of expense to be reported on the income statement. The percentage of sales method employs the expense recognition concept, also called the matching concept, probably on a monthly or quarterly basis. The amount of cost that has been incurred in order to earn a certain amount of revenue and to recognize both in the same period. The entry to record the uncollectible account estimate debits the uncollectible account expense account and credits the allowance for uncollectible accounts. The other popular method for estimating uncollectibles is called aging of accounts receivable. The aging method is a balance sheet approach because it focuses on what should be the most relevant and faithful representation of accounts receivable as of the balance sheet date. In the aging method, individual receivables from specific customers are analyzed based on how long they have been outstanding. This is an example of an abbreviated aging schedule. Customer account balances are grouped by days outstanding. A percent collectible is estimated for each category. The older the account, the less likely payment will be received. The totals on the columns come to $100. This is the amount the allowance account should equal after adjustment. Assume the allowance account had a beginning balance of $25. An adjustment of $75 would be needed. The accounts used to record uncollectible accounts expense are the same regardless of the method used to estimate the amount of the adjustment. When a specific customer account is deemed uncollectible, the allowances account is reduced for the amount of the customer account. Accounts receivable is credited to remove the customer's account from the books. The write-off of uncollectibles has no effect on a company's total assets, no effect on current assets, and no effect on net accounts receivable. There is no effect on net income either. Net income is unaffected because the write-off of uncollectibles affects no expense account. If the company uses the allowance method, as discussed previously, expenses would have been properly recognized in the period they were incurred, which is the same method in which the related sales took place. Comparing the two methods, one can see that the percentage of sales approach focuses on the amount of the uncollectible accounts expense, an income statement approach. On the other hand, the aging of receivables method focuses on the amount of uncollectible receivables, or a balance sheet approach. There is another, less preferable way to account for uncollectible receivables under the direct write-off method. Under this scenario, the company waits until a specific customer's receivable proves uncollectible. Then the accountant writes off the customer's account and records uncollectible account expense. The direct write-off method is not considered generally acceptable accounting for financial statement purposes. It's defective for two reasons. It uses no allowance for uncollectibles. As a result, receivables are always reported at their full amount, which is more than the business expects to collect. And so assets on the balance sheet may be overstated, and it also causes a poor matching of uncollectible account expense against revenues. A company earns revenue and then collects the cash from customers. For most companies, there is a time lag between earning the revenue and collecting the cash. Collections from customers are the single most important source of cash for any business. You can compute a company's collections from customers by analyzing its accounts receivable account. Receivables typically only hold 5 items as reflected in the 5 elements of the accounts receivable account balance. Now we'll talk a little about how to account for notes receivable. Notes receivable are more formal than accounts receivable. Notes receivable due within 1 year or less are current assets. Notes due beyond 1 year are long-term receivables and are reported as long-term assets. Some notes receivable are collected in installments. The portion due within 1 year is a current asset and the remainder is long-term. So let's talk about some key terms. A creditor is the party to whom money is owed. The creditor is also called the lender. A debtor is the party that borrowed and owes the money on the note. The debtor is also called the maker of the note or the borrower. Interest is the cost of borrowing money. The interest is stated in an annual percentage rate. Maturity date is the date on which the debtor must pay the note. Maturity value is the sum of principal and interest on the note. Principal is the amount of money borrowed by the debtor, and term is the length of time from when the note was signed by the debtor to when the debtor must pay the note. There are 2 parties to the note. The creditor accepts a note receivable, the debtor issues a note receivable. This figure shows us a typical promissory note. The principal amount of the note, $1,000, is the amount borrowed by the debtor lent by the creditor. This 6-month note receivable runs from August 31st to February 28th, when Lauren, the maker, promises to pay Continental Bank, the creditor, the principal of $1,000 plus 9%. Interest is revenue to the creditor and an expense to the debtor. Using the promissory note on the previous slide, we will record entries for transactions related to the note in the accounting records of Continental Bank. So after Lauren Howland signed the notes, Continental Bank gives her $1,000. The bank entry on August 31st would show an increase to notes receivable and a decrease to cash. Continental Bank earns interest on the note from August to February. At December 31st, the bank accrues interest at 9%, so interest receivable is debited and interest revenue is credited for the amount of $30, or $1,000, which is the value of the note, times 9% times 4/12, or the period of time between when it was issued and year end. The bank collects the note on February 28th and records the receipt of cash. 3 accounts are credited: notes receivable for the principal, interest receivable to zero at the amount recorded in the adjusting entry at the end of the prior year, and interest revenue to record the amount earned in 2013. You should probably remember some specific items about interest. Interest rates are usually expressed as annual percentage rate. Therefore, if interest is being accrued for a period less than 1 year, a fraction is used in the formula. For example, if a note received was signed on November 1st, the year-end accrual would use 2/12 in the formula. Often interest is computed in days instead of months. In this situation, the denominator of the factor would be 365, the number of days in the year. So the next topic that we would like to spend a little bit of time on is how to speed up cash flow from receivables. All companies want speedy cash receipts. Rapid cash flow means companies have the ability to pay off current liabilities faster, as well as to finance new products, research, and development. Thus, companies develop strategies to shorten the credit cycle and collect cash more quickly. For example, they might offer sales discount for early payment, as discussed earlier. They might also charge interest on customer accounts that exceed a certain age. They adopt more effective credit and collection procedures. In recent years, as electronic banking has become more popular, a common strategy has been to emphasize credit card or Bankcard sales. A merchant sells merchandise and lets the customer pay with a credit card such as Discover or American Express, or with a bank card such as Visa or MasterCard. This strategy may dramatically increase sales, but at the added revenue comes a cost, which is typically about 2 to 3% of the total amount of the sale. Let's see how credit card sales and bank cards work from the seller's perspective. Suppose a company sells products for $5,000 and the customer pays with a Visa card. The entry to record the sale is shown in this presentation. So the company sells the products for $5,000, but because the customer uses a credit card to pay for them, we're only going to, and we have a transaction fee associated with that, which is 2% in this example. We're only going to receive cash of $4,900. The credit card discount expense, which will hit the income statement, is reported at $100, and we record sales at the gross amount as a credit to sales of $5,000. A company may make some large sales to other retailers on account, debiting accounts receivable and crediting sales revenue. This company might then sell these accounts receivable to another business called a factor. The factor earns revenue by paying a discounted price for the receivable and then hopefully collecting the full amount from the customer. The benefit to the company selling the receivables is the immediate receipt of cash. The biggest disadvantage of factoring is that it's often quite expensive when compared to the cost of retaining the receivable on the books and ultimately collecting the full amount. In addition, the company that factors its receivables loses control over the collection process. For these reasons, factoring is often not used by companies who have other less costly means to raise that cash, such as short-term borrowing from banks. Factoring may be used by startup companies with insufficient credit history to obtain loans at a reasonable cost, by companies with weak credit history, or by companies that are already saddled with a significant amount of debt. And so now we want to shift discussions to how we evaluate liquidity using two new ratios. The balance sheet lists assets in order of relative liquidity. So first is cash and cash equivalents, second are short-term investments, and third are accounts or notes receivable. Managers, stockholders, and creditors care about the liquidity of a company's assets. The current ratio measures ability to pay current liabilities with current assets. A more stringent measure of ability to pay current liabilities is the quick or acid test ratio. The higher the quick ratio, the easier it is to pay current assets. Traditionally, companies have wanted an acid test ratio of at least 1.0 to be safe. The ratio needs to be high enough for safety, but not too high. After all, cash and other liquid assets don't earn very high rates of return as inventory and plant assets do. After a business makes a credit sale, the next step is collecting the receivable. Days sales in receivable, also called the days sales outstanding or the collection period, tells a company how long it takes to collect its average level of receivables. Shorter is better because cash is coming in quickly. The longer the collection period, the less cash is available to pay bills and expand. Days, sales, and revenues can be computed in two logical steps. First, compute the average daily sales, or average revenue for one day. Then divide the average daily sales into the average receivables for the period. Net sales come from the income statement, and the receivable amounts are taken from the balance sheet. Average receivables is simply the average of the beginning and ending balances. Companies watch their collection periods closely. Whenever collections slow down, the company must find other sources of financing, such as borrowing or selling receivables. During recessions, companies pay more slowly, and a longer collection period may be unavoidable. All right, in short exercise 5-19, we're required to compute Lakeland Clothier's acid test ratio at the end of 2013. We find that the company's acid test ratio compares favorably to the industry average of 0.95. Continuing with short exercise 519, we're required to compare Lakeland Clothier's days sales and revenues for 2013 with the company's credit terms of net 30 days. The days sales and revenues ratio 33 is favorable relative to the 30-day period of the credit terms. So what this tells us is that on average, we are collecting our receivables within 33 days, which compares favorably to the fact that we have terms of net 30 from our clients or due from our customers. And so this concludes Chapter 5. Let's go back and read the text and then go in and work the problems that are in the practical exercises. And if any of this doesn't click and doesn't make sense as you read through the text or start practicing on the problems, don't hesitate to contact the professor for additional clarifications. Thanks, and I look forward to talking with you again when we start up on Chapter 6 next.